What is going on, guys? We're back again with another video, and in today's video I'm going to show you exactly why your trading is failing. Your trading is failing because you don't have an understanding of these two concepts, and these two concepts have helped me allocate over $1 million in funding capital, as well as help many other traders pass funded accounts and receive payouts. Now, these two concepts are SMT divergence and internal and external range liquidity. Now, if you want to learn from me directly, all you need to do is go to the description of this video and click the link. It'll direct you to my free Discord where I host free classes on these exact concepts. Now, let's hop right into the video so I can break everything down for you. All right, guys, jumping right into the chart, I have a schematic of both an uptrend here and a downtrend on the right. Now, like always in all my previous videos, I do blank charts. So when you're looking at just this plain schematic here on both a bullish and a bearish trend, what is the market doing? It does one of two things. It seeks old highs and lows and rebalances imbalances. Now, let me show you the annotations on the next slide so you have a better depiction and understanding of the concepts that we're going to cover in this video. With my annotations here, it's very clear to see. So when we have an uptrend, price has an impulse high, then creates a swing high resting here. After we have that swing high created, what do we do next? We retrace into an imbalance, an internal range liquidity pool. Then after we retrace into the internal range liquidity pool, it has to seek another old high, this external range liquidity pool, because the price of the market moves from internal to external, then to internal, then to external. Impulse, retracement, impulse, retracement, impulse. That is a trending market in which we are in a bullish trend. Now, vice versa, same thing for a bearish trend. We are having an impulse low, creates a swing low resting here, and price retraces into an internal range liquidity pool, this imbalance right here. We rebalance that. After we retrace into that internal range, we draw down lower to the external range liquidity pool. Now, that is just the general basis foundation understanding of how the market simply books price. Now, I want you to add this next concept into your trading arsenal, because in order for price to go from the internal to the external range liquidity, this next concept will validate that trend move to the external range target to continue its order flow. So now the same thing on the previous slide when I just gave a plain schematic. I'm using a different diagram having NASDAQ's depiction on the left and the S&P 500 on the right. So pretend that these are two different charts and two different correlated pairs. Now, in a corresponding trading market, when NASDAQ makes a high, you would expect that ES would make a high. And when the NASDAQ makes a low, you would expect the S&P 500 to make a low. But the difference and the extra concept that I'm telling you to incorporate here is SMT divergence, which is the cracking correlation between two correlated assets in a market. So when price is retracing after its impulse into an internal range liquidity pool, you're going to want to look for SMT divergence to occur inside the imbalances or the fair value gaps. Because when we have a tag of an internal range liquidity pool and SMT divergence at the tag or inside of that gap, that is confirmation of price continuing in its trend and respecting that PD array and utilizing it as a reference or support to then seek that external range liquidity pool target, that high. So before I show the annotations just from this schematic, I want you to pause the video, mark up yours, and see if it can match mine on the next slide. So if you got that correct, we have a fair value gap resting here on the NASDAQ and a fair value gap resting here on the S&P. Both of them traded into, but there's actually a lower fair value gap resting here and a lower fair value gap resting here as well. That is tagged by the S&P 500 and not tagged by the NASDAQ. So what is that telling me? That's telling me that the NASDAQ is a stronger pair compared to the S&P 500, because you could see this candle low was taken out resting here, and same with this candle low was taken out resting here. We failed to take out this low and failed to take out this low, respecting the higher fair value gap and pushing higher. With the S&P 500, cleared more liquidity, running this short-term low and digging deeper into this lower fair value gap. So if I was looking to trade this exact pair, I would want to focus on the NASDAQ. So let me show my annotations on this next slide. This is your SMT divergence and what you're looking to occur inside of that internal range liquidity pool for you to then move on to looking for an execution in the marketplace. And it is the same exact way, just vice versa, flip-flopped if you're bearish. Now, if you look again, same thing. We have a fair value gap resting here, and we have a fair value gap resting here, same one. But there is a higher one resting here and here that is tagged on the S&P 500 and fails to tag it on the NASDAQ. So if we have a short bias, what we're going to be doing is shorting the weaker pair that makes the lower high inside of the lower internal range liquidity pool. So that is going to be our priority if we want to sell the NASDAQ compared to selling the S&P 500, which makes the higher high. When you use these two concepts, internal and external range liquidity, paired with SMT divergence, that is going to be your base foundation and your golden scroll to seek high probability trading conditions. And I promise you, you will watch your win rate increase dramatically and also limit yourself to the amount of trades that you're taking in a given week or even a day. I want you to stick with this one rule and understand that if there's no SMT divergence, there's no trade. Make that a very strict rule for yourself when you're looking for executions, because understand this, SMT validates all of your trade ideas. So now that you guys saw this schematic on everything for internal and external and SMT divergence, I'm going to show you a trade that I took and a example of the S&P 500 and the NASDAQ in this exact representation. So here's our representation of the NASDAQ on the left and the S&P 500 on the right. Now we are looking at an M15 chart, and I want you guys to pause the video here and mark up your annotations based off of the concepts that I just showed you on the previous slide to see if you learned anything. So I'm going to show my annotations now, and if you got that correct, we have a tag of an M15 bearish fair value gap, this internal range liquidity pool here, and a failure to reach into the M15 corresponding fair value gap on the S&P 500. So what is that telling me right off the beginning? That we have SMT divergence at the tag of the internal range liquidity pool for NASDAQ and a failure to tag on the S&P. So this is indicating to me that the S&P 500 is the weaker pair. So I want you to understand something. You don't need a tag of an imbalance on both pairs. That is a big misconception that people aren't understanding. All you need is a tag of an imbalance on one of the two correlated assets. Because here you could see that if the S&P 500 is failing to reach this gap, you could still frame the trade because the NASDAQ tags the gap. So since the NASDAQ rebalanced this imbalance, that would leave the S&P 500 creating a breakaway gap, allowing price not to need to trade back into this gap in price. So since we're on the M15 chart, we have an M15 internal range liquidity pool that we want to have price draw down to an external range low. So our time frame alignment would be an M15 internal range liquidity pool tag key level to an M1 market maker sell model to the M15 external range liquidity pool low. So here is the M1 chart on the NASDAQ and the S&P 500. Now this candle, this singular candle resting right here, is the candle that tags the M15 internal range liquidity pool. It runs short-term highs resting here, and you could see the same thing here on the S&P 500. This singular candle is the same one simultaneously that creates that higher time frame SMT divergence. that also runs short-term highs. So this candle to me is definitely significant because it runs liquidity and it created the M15 SMT. So I'm gonna label this as my potential for an order block to form to frame a short entry to the M15 external range lows. Now moving forward, all we're looking for next is for price to close below the opening price of that candle that we had labeled off before, that ran liquidity and created the M15 SMT. Even though we did run a little bit higher, we still stayed below the M15 internal range liquidity pool, and we're still creating a change in state of delivery and creating an order block closing below this exact candle. So that is identifying the first initial potential move for us to take a short entry to that M15 external range liquidity pool. So all I would do next from this point on, I would look for a short opportunity at the tag of this up close candle opening price. And I would put my stop loss, if I'm going short here, at the resting high that created the SMT divergence. So in my eyes, since this is the high right below the M15 internal range liquidity pool, I would assume that this is protected and we could draw lower. Because again, SMT divergence validates all of the trades that you take. It identifies protected lows and protected highs. So in this case, this would be my protected high and comfortable for me to then take heat if price retraces up higher, for this to stay intact, for us to draw lower to that M15 external range target. So I would be in short, resting right here with my stop loss at the SMT rested highs, and I would only look for a 1 to 2 risk to reward from that M1 order block tag. And simple as that, you could see, since I put my stop loss at that resting high that created the SMT, I was able to withstand the heat, withstand the drawdown, and secure a 1 to 2 risk to reward off of that trade. Now, after you secure a 1 to 2 risk to reward, you could take the full position off, or you could take 80% of the position off, leave a partial running to the M15 external range target with your stop loss break even, and you could see here price smoothly runs to that low. And I hope you guys really understood how simple it is for price delivery to book in these markets when you narrow down your watch list and your checklist to just such small, simple steps. And those simple steps, like I said, internal range and external range liquidity and SMT divergence, those are your golden rules. Those are going to be what frames you and sets you up in only high probability trading conditions. And you can see just by the ways and all of the trades that I put out before in the past, this pattern repeats itself week in and week out, day in and day out. It doesn't stop, and it won't stop ever. I promise you that. Now, I really hope you guys enjoy this video and you're taking something from it, and I'm able to provide value to you. I see all the trades that you guys are taking on Twitter, Instagram, and stuff like that, tagging me, and it just makes me feel so happy that you're able to implement the same strategy that has brought me profitability, and it's assisting you in your journey. But these videos won't stop, and I'll continue to upload and show you guys the same process week in and week out. But like always, much love. Appreciate you guys, but I'll catch you next week in the next upload.